Hey there, welcome back to Desi Return. In today's video, we are going to dive into another important topic on how you could access your retirement savings like 401k or IRAs early without paying penalties, the 72T rule. If you're planning to retire early, or you're going through a career change, or you want a cash flow, this might be an option worth considering, but it comes with strict rules and risks that you need to understand. So stick around till the end where we talk about how this is taxed in India if you plan to move to India, and for my own recommendation on whether this could be a right fit for you or not. Let's start with the basics. So the 72T rule is also called substantially equal periodic payments, SEPP, allows you to withdraw funds from your 401k or IRA before age 59 and a half without paying 10% penalty, which is the early withdrawal penalty. However, you must follow strict rules to avoid the penalties. So why should someone consider 72T? Here are some common scenarios where it might make sense. First, early retirement. If you're retiring early in your 50s or 40s and you need income before you have access to your social security or pension. Second, career change. If you're starting your own business or you're moving from one job to another job and you need access to cash flow, that could be one scenario. And third, you want to avoid higher taxes later. Spreading out withdrawals can reduce future tax that are coming from required minimum distributions at age 75. Let me talk to this a little bit. If you have a high corpus amount in your 401k or IRA, there is a rule at age 75, you have to take a minimum distributions. So depending on your corpus amount, by taking that minimum distribution, the withdrawals could put you at a higher tax bracket. If you want to minimize that higher tax bracket, you want to start these withdrawals early and you are spreading them out so that you are avoiding the higher tax bracket later. So that is the reason why someone might want to consider the 72T distributions. Now that we understand where it could make sense, let's dive into how this would work. First, you need to determine the calculation method. The IRS allows three ways to collect your withdrawals. First, required minimum distribution, which is RMD method. Withdrawals change annually based on the life expectancy and the portfolio performance. Second, fixed and amortization method. Fixed withdrawals based on life expectancy and a chosen interest rate. Third, fixed annuitization method uses a annuity formula for fixed payments. So you need to determine which withdrawal method that you want to choose. Second, withdrawals must continue for at least 5 years or until you reach 59 and a half, whichever is the longest. Keep that in mind, whichever is the longest. And payments must be taken at least annually. Third, avoid modifying the payments, changing or stopping payments, except for certain IRS approved changes, can trigger penalties requiring you to pay 10% early withdrawal penalty retroactively. So for the withdrawals that you have taken previously. So from a method of withdrawal, my recommendation is to go with a fixed annuity or a fixed amount method where you can decide whether it's a 5% or a 10%. This helps to avoid miscalculations or paying any penalty. So let's walk through this with an example. Say you are in your 40s and you want to set up 72T, which will continue until 59 and a half years. So First, you need to determine the amount that you want to withdraw annually. Say you want to withdraw 20,000 per year. Second, you need to determine how much you need to fund the 72T IRA account. Because you're starting at 40 and it will go for 20 years. So multiply the annual distribution amount, which is 20,000 with 20 times. So that would be 400K. So you would start with the 400K initial balance. You would open a brand new IRA account, which is for your 72TA. And you transfer that 400,000 from your 401K or IRA into this brand new 72T IRA account. Next, you need to withdraw money every year, but you should never add any new money to the 72T IRA account until the withdrawals are completed. You can invest the money in the IRA account in whatever way you like, and the amount would continue to grow. Last, don't forget to take the annual distribution, if even for a single year. Forgetting that for 1 year could cause penalties, and you have to pay taxes and penalties on the prior withdrawals. So now that you understand how 72T works, before you jump onto it, let's talk to the downsides of 72T. First, strict rule and commitment. You must continue withdrawals for at least 5 years or until 59.5 years. Second, potential for high taxes. Withdrawals are taxed as ordinary income, which could push you into a higher tax bracket. Third, no flexibility once started. You can't adjust payments based on the market performance or personal financial needs. You have to stick to the withdrawals plan that you have started off with. Last, risk of running out of money. Early withdrawals may deplete your retirement savings too soon. So these are the downsides, and you need to understand before you decide if this is the right plan for you. Now let's understand the tax implications if you're moving to India. So if you move to India, the tax depends on your US tax residency status as well as Indian tax residency status. For US citizens, green card holders, or US tax residents, the withdrawals are taxed as an ordinary income in the US. If you are a non-resident alien from a US tax perspective, you can submit Form W8BEN to your brokerage account, referring to DTAA clause, where 72T withdrawals fall under periodic pension payments, and such that they are not taxable in US, but only taxable in the country of residence. So for non-resident aliens, this is not taxable in US, but will be taxed in India. So in India, the taxation depends on your residential status. If you are RNOR, which is resident but not ordinary resident, these withdrawals are tax-free. If you need more information on RNOR, check out our video here. Once you become a full tax resident, the withdrawals are taxed as per Indian tax slabs. So in a situation where you pay taxes in US, you can offset those against the Indian taxes to avoid double taxation. So now let's talk about some key things to keep in mind for the 72T withdrawals of the process. First, there is no age limit on when you can start this. Second, no restriction on the amount that you can withdraw. Third, there is no restrictions on how many different 72T withdrawals you can have. You can start one in 2024, you can start another one in 2028, and so on. You can have multiple 72T withdrawals, and there is no restriction on how many you can have. Fourth, you can't add new money into a 72T IRA once it started. And last, create a separate IRA so that it's easy to manage, and you need to withdraw funds at least on an annual basis to avoid the penalties. So is 72T right for you? Here is my take. if you're retiring early and need income until you get your pensions or social securities, and as long as you can stick to these rules, it could be a choice that you can consider. But if flexibility is important, you might be better off using other strategies like Roth conversions or non-retirement savings, because the rules are very strict and you have to follow them. So before making a decision, please consult a financial advisor to see if 72T fits with your plan or in your situation. If you found this video helpful, don't forget to like, share, and subscribe for more insights on the things that you need to be aware of for making an informed decision for moving back to India. Also, we have a very thriving WhatsApp community where you can get your questions answered, join our network with other returnees. The description, the link for the WhatsApp is in the description. So until next time, have a good day.